Hello, welcome everyone to the discussion on SL REITs and its tax implications. SL REITs, or the Sri Lanka Real Estate Investment Trust, is a fairly new concept to most of the Sri Lankans. But as you all know, it's a well established business model in most of the parts of the world, especially developed countries, including our neighboring country, India. Before moving into the detailed discussion on the tax implications, it's worth to have a fair understanding of the business model and how it works. Because without a fair amount of understanding, understanding the tax implication would not be that easy. My presentation is broadly divided into two categories. One is business model and how it works, the concept, and the tax implications arising on SL REITs. So let me share my presentation with you all. REIT, Real Estate Investment Trust. What is a REIT? Real Estate Investment Trust is a subcategory of unit trust. Important. It is a subcategory of unit trust. So in other words, unit trust and REITs are quite similar, and which acts as a collective investment vehicle. REITs pool money from public investors, and such money could be used to acquire residential and commercial property, retail or industrial properties, infrastructure, or other real estate related assets. Now, as I mentioned earlier, it's quite similar to a unit trust. So, what is a unit trust? So, unit trust concept and this concept is more or less the same. But before studying the REIT structure, the model, it is worth if we can have a understanding of the unit trust model. Unit trust structure. So in a typical unit trust structure, there are three parties involved mainly. One is unit holder, that is the party who is investing in the unit trust. And then the manager and the trustee. Unit holder is the one who is investing in the unit trust. The manager is the party who manages the unit trust. And there are licensed unit trust management companies in Sri Lanka. And trustee is the one who is looking after the assets of the unit trust. That is always a bank licensed by the Central Bank of Sri Lanka. In a typical unit trust, how it works, unit holder invests in unit trust, and then unit trust invests in different types of investments, such as government securities, debt instruments, equity instruments, fixed deposits, etc. So the income return received by the unit trust after the payment of trustee fees and management fees is the entitlement of the unit holders. That is the concept. And on that concept only, all the trust deeds and other relevant documents are designed. So that is unit trust structure. Then REIT structure. If you carefully look at this, the same concept remains. Unit holder, trustee, manager, and the investment vehicle. That is REIT. Here it is the REIT, Real Estate Investment Trust. So the same structure. Unit holder invest in REIT. What he can invest here? Not money. Here you have to invest a property, eligible property. So you can invest a property in a REIT. Your property has to be transferred to the REIT. So in return, you will receive units and trustee is the party who is looking after your asset, and manager is the party that manages the operations of the REIT vehicle. So the property you transferred, the unit holder transferred to the REIT is in fact the REIT will be earning rental income from that asset, and at the end when the REIT sells this asset, there will be a gain in the hands of the REIT. And then there are some distribution requirement. When the REIT receives income, that is rent income, REIT there is a mandatory distribution of 90% of the income to the unit holder. So you as the investor, you will receive annual rental income from the REIT, that is 90% of the distribution. It's rental income. And you can sell your units at any point of time because it's a listed security. So you can sell it at any point of time and realize your money. Important factor here is that when the underlying asset, that is a property, value goes up, the value of the units will automatically go up. So based on the valuation movements, you can decide the price of at what point you are going to sell these assets. And the return of the trustee is the trust fees for taking care of the assets, and for the management of the business activity, the model, the management company will receive management fee. And in addition to these three parties, there is another party here, that is a property manager. So this is not relating to a financial asset. So therefore, the party, the special party, property manager is involved because for the management of the property. Otherwise, now if it is a security like shares, so the REIT vehicle and the manager will have a technical staff to manage the investment. But whereas in the case of REITs, properties, the always it is advisable and good always to have a property manager specialized in that subject. Right. Eligible properties. What are the eligible properties? First thing, there are conditions to be satisfied. One, it should be a fully completed property, right? And fully or partly occupied. And it should generate income, that is rental income. Right. Mode of acquisition by the REIT may be an outright purchase or maybe a lease. So the REIT can acquire this asset, either by outright purchase or by way of a lease. Some examples of type of properties are residential properties, which generates rental income, commercial buildings, warehouses, hospitals, hotels, infrastructure projects such as power generation projects, power plants. Right. What are the benefits of REITs? Now you always have to study this. I mean, if there is benefit only, the investors are attracted. So it is always good to see the benefits available in this REIT structure. One core principal benefit is that now, if you were to invest in property sector, you have to have a couple of millions at least. So small investors, they don't have capacity to invest in real estate properties, but REIT scheme facilitates the small investors, maybe employees, to invest part of their remuneration in REIT structure, because it is again the units. So you can simply purchase a unit of a REIT structure for a small value. Whereas if you were to buy a property, that will cost you a considerable amount of money. That is the main and core benefit that is arising on this, available in this business model. Number two, increase return from growing property sector. Now you can see during some periods the property sector is growing at a higher pace. So if you invest in these units or other REITs, you will always have the luxury of entertaining higher value appreciation of properties. And in fact, when the property value goes up, that is the underlying asset, automatically valuation of units will also move upwards. So that is kind of a those two assets are linked to each other. Rather, underlying asset is the land or rather property, and the linked asset is the unit. So capital appreciation reflected in unit price, as I mentioned, ability to minimize volatility through 90% rental distribution. So as I mentioned earlier, there is a mandatory distribution of 90% as per the regulation out of the rental income received by the REIT. 90% is to be distributed. That may be their profit, need not to be the gross income, but they have to distribute 90%. Liquidity added to the market through listing. Of course, it is a listed security, as I mentioned earlier. So you can at any point of time exit by selling these units. And also here a special feature is that always mandatory valuation are involved. So there is a bit of a higher transparency involved, right? And also there are some tax concessions available to REITs investment. So therefore there are some considerable benefits available for REITs investments. Then taxation of REITs. Before that, we have to have an understanding of taxation of unit trust, because as I mentioned earlier, unit trust as well as REITs are quite similar, and you can say they are identical structures. So how unit trust is taxable in Sri Lanka is defined or is determined based on different after considering different tests, and it is a very broader explanation, broader study. But for the simplicity of the listeners, I have prepared this presentation on the tax implication in a very conclusive manner. So if you take unit trust taxation in Sri Lanka, first question you have to ask is whether this unit trust is engaged in eligible investment business or not. If it is engaged in eligible investment business, section 57, that is trust principles are applicable to the taxation of that unit trust. If the particular unit trust is engaged in non-eligible investment businesses, right? So the section 59 of the Inland Revenue Act is applicable, and it is considered as a company. But as these all unit trusts in Sri Lanka are governed by Securities and Exchange Commission, so without any doubt, I can mention that all the unit trusts in Sri Lanka are engaged in eligible investment business. Right. Then what is the section applicable? That is section 57. Right. Then the second question is to be asked is whether the unit holder has a present entitlement to the trust income. If you say no, section 57(1) applies. If there is no present entitlement to the trust income, so section 57(1) is the section which is applicable to the taxation of unit trust. If so, taxation arises at the trust level. So if you pay tax at trust level, applicable tax rate is 24%. But without any doubt, I can say by looking at the trust deed structures used in Sri Lanka, there is a vested, or rather, there is a present entitlement to the trust income. What do you mean by present entitlement? It is defined in the Inland Revenue Act. Simply, if you say it simply, if the unit holder has a vested and indefensible immediate right to the trust income, there is a present entitlement. Yes, there is a present entitlement because at any point of time, the unit holder can sell his units and realize his money, profits and income. So therefore, we can conclude that there is a present entitlement to the trust income. So the applicable section is section 57(2), right? So section 57(1) applies where the unit holder doesn't have a present entitlement, and section 57(2) applies to the cases where the unit holder has a present entitlement. So we have no doubt on that. Almost in all the cases, the unit holder has a vested and rather what you call present entitlement, that is vested and indefensible immediate right to the trust income. Right. On that conclusion, we can say that in Sri Lanka, taxation of unit trusts is based on the pass-through system. So when there is a vested and indefensible right to the trust income, taxation is at the unit holder level, not at the trust level. So let's look at how it works. Taxation of unit holders under pass-through system. So it is tax based on the present entitlement to the trust income. So is taxable in the hands of the unit holders based on the taxation principles applicable to particular unit holder. Let's say a unit holder invests in a unit trust and unit trust invest in a FD. So the income received to the unit trust is the unit holder has a present entitlement to the trust income, that is to the interest income. So interest income is taxable in the hands of the unit holder because he has a present entitlement to the trust income, right? So investor or the unit holder may be an individual or a corporate. So based on the taxation principles applicable to the respective unit holders, it will be taxed. If it is an individual, it will be taxed on progressive rates, whereas if it is a corporate investor unit holder, that will be taxed at whatever the rates applicable to them. Most probably on normal tax rates, 24%. But the important fact here is that the character as to type and source of trust income passes to the unit holder without any change. If the trust receives interest income, that will pass on to the unit holder as it is. If the trust receives interest, it will pass on to the beneficiaries as interest. If the trust receives dividend, it will pass on to the unit holder as dividend. So there won't be any complications. So based on the source, you can decide the tax liability, right? Distributions by a unit trust are exempted. So this is important. Distributions by a unit trust is exempted under section 58. Right? This is as per the prevailing provisions of the Inland Revenue Act. Right? And finally, gain on realization of units is liable for income tax. Right? But let's say you invest in a fixed income security unit trust, fixed income unit trust, and in turn, if they invest in a debenture, say you invest 100 rupees, and during the year the interest income is say 10 rupees. So conceptually, the price of the unit is 110, and you have already paid tax on the present entitlement, that is 10 rupees, right? Now let's say at the end of the year, you sell the unit. So the gain is calculated as the consideration versus cost. Your consideration is 110 versus cost. What is your cost? You invested 100 rupees. So there is a gain of 10 rupees. So is it taxable? As per the provisions, yes, it is taxable. But I have paid tax, you have paid tax on the present entitlement. That is this 10 rupees. The appreciation of the value because of the interest income. So there is a duplication of tax. No, it is not. The gain is to be calculated as the consideration versus cost. Consideration, yes, 110 rupees. Cost, initial cost 100 plus income amount that you have already declared for tax, that is 10 rupees. So your cost is 110, that is your initial cost plus income amount that you have already declared for tax purpose. So what would be the gain? 0. So there won't be any duplication of tax. So this is how unit trust taxation is happening, but it is not that simple when it comes to practical situations. So there are so many complications involved. So, but to make it simple, I have simplified the taxation of unit trust. Right. Now, taxation basis of REITs. The pass-through system that we discussed with regard to unit trust will be available for REITs as well. So pass-through system presently available to unit trust will be available for REITs as well. That is, the income received by the unit, the REIT will not be taxed in the hands of the unit trust, or rather REIT. That will be passed on to the unit holders, and it will be taxed in the hands of the unit holders. When you say it is taxed, subject to the concessions available. All right. Now, there are existing concessions as well as new proposed concessions on this model, the business. Additional benefits proposed in the National Budget 2021. Now, income tax exemption on capital gains arising on such investment. That was a proposal in the National Budget 2021. Now, this is little tricky, and carefully we need to study this. You see, the income tax exemption on capital gains arising on such investments, that is REITs investments. So there are two things. One, individual investor goes and invests in unit trust, and also the unit trust invests in properties, or rather REIT vehicle invest in the property. So both will have to understand. Now, this capital gain exemption, is it applicable to these cases? Let's say from the point of the unit holder, is it a capital gain or a business income is a very subjective area, because for a banker investing in units, or other real estate company investing in units of a REIT can be an business asset, capital asset of a business. And also, or else it can even be trading stock, right? But for an individual or a manufacturing company, that could be an investment asset. So if the treatment differs, if it is only for capital gains, the exemption will be available only for the people who are doing this as an investment. But whereas for the bankers and the other parties who are investing in these securities as a business, it will be part of their business income. So if it is limited to capital gains, that is entire distortion to the new born concept, because there shouldn't be any discrimination between the investors. So therefore, when the exemption is granted, that should be given commonly for the investments in REITs. Shouldn't be limited only to the capital gains. So that will lead to so many complications, arguments with the revenue department. And on the other hand, when the unit trust or other REIT vehicle sells its property, there can be a gain. So is it taxable? So again, the same question arises to the REIT vehicle. Is it a business asset, that is a capital asset of the business, or an investment asset? That again subjective. Let's say there is a unit REIT vehicle, if they are involving in the management operation of the property, so there is a bit of a indication of a business character, so that it can be considered as a this capital asset of a business. But whereas the another REIT vehicle, their involvement in management, in management of the REIT vehicle could be very much less, and their involvement would be very passive. So for them, that could be categorized as an investment asset. So you see, based on their involvement, the business structure and how they handle the operations define the type of the assets. Based on the type of the assets, the tax liability varies. So again, it should not be limited to capital gains. I think it should be given broadly, openly, for the realization of assets by or properties by REITs. Otherwise, it will again lead to unwanted disputes, arguments at the very beginning of this business model. So that will definitely harm the development of this business model. Right. Now, the income tax exemption on dividends. Anyway, as per the prevailing provisions, that is section 58, distributions by a trust is exempted in the hands of the recipients. So that is there in the existing law. But the question is, the taxable income in the hands of the REIT is the rental income. So as I mentioned earlier, beneficiaries, unit holders are taxable based on the present entitlement. So they have present entitlement to the trust's income. What is the income? Rent income. If that rent income is not exempted in the hands of the REIT, that will be taxed in the hands of based on the present entitlement. That is, the unit holder or the beneficiary, they have a present entitlement to the trust's income, and it will be taxed. So I think this has to be carefully handled. The income of the REIT vehicle, that is the rent income, has to be exempted. Otherwise, there is no point in exempting the distribution. In fact, that is already available in the Act, because the distribution is not taxable, but it will be taxed on the basis of present entitlement. And the other good thing is that stamp duty has been limited to 0.75%. That is, when you transfer the asset property to the REIT, and when the REIT sells the assets. So I think the proposal will capture both transfer by the unit sponsor, that is the investor, as well as the sale of the properties by the REIT vehicle. So this, I believe, covers a fair amount of tax implications. But when this moves on, the discussions will be there, developments will be there. So, of course, this is the initial stage. So, but one important factor here is that I want to emphasize that at the very outset, it is pertinent, it is very important that all regulators, CSC and Inland Revenue Department, has to work together. Otherwise, this newborn child cannot survive with unwanted tax disputes. So hopefully we will have a better investment instrument in near future, and wish all the very best to the regulators and the parties involved in this effort to have a successful investment platform. And thank you very much, and wish you all the very best, and wish you a very happy new year. And again, thank you very much, and I'll see you all with a new subject in the near future. Thank you very much.